Hello, my friends. Today is November 1st, and this is Markets Weekly. So this past week, super exciting week in the markets. We had the Fed meeting. There's a video about that on the channel. And of course, we had Trump's tour in Asia, as well as Mag 7 earnings. Now, Meta disappointed the market, was down a lot, but everyone else was okay. Amazon, notably, up 10% after earnings. So the broad markets, I think, were overall mixed. Today, let's talk about three things. First off, let's briefly review what happened with the president's trip in Asia, where we got more details about the big investment deals Japan and Korea had promised the president. Secondly, the World Gold Council released their latest report on the supply and demand factors driving gold prices higher, so let's take a look at that. And lastly, there's brand new research from the Federal Reserve on the impact of tariffs on U.S. manufacturing, and so far it's not positive. But maybe we can find out why. All right, starting with the president's trip in Asia. So let's level set a little bit. Over the past few months, again, a lot of trade headlines. The president sought to renegotiate the U.S.'s trade relationships with the world. Now, what we found out after all this excitement was that the U.S., for the most part, has much more leverage over other countries than previously thought. In particular, countries like Japan, South Korea, Taiwan, European Union need the U.S. for defense and also need access to U.S. markets. So the U.S. was able to extract significant concessions from them. In the case of Japan and Korea, in order to buy down their tariffs, they were willing to make huge investments into the United States. The way that I look at this is that over the past few decades, these countries have been making a whole lot of money off global trade, accumulating large foreign exchange surpluses, and the president is basically taking all that back by forcing them to invest in the U.S. Now, the one exception in all this, of course, is China, which we found out that the Chinese are very strong. They have something, rare earths, that the U.S. absolutely needs. And of course, they have a much higher pain tolerance. So in a sense, China probably stronger than the U.S. when it comes to the trade deal. So over and over again, we have what appears to be the White House reaching out to China, well, doing something strong, and then reaching out to China to try to climb down. And that seemed to happen this time as well. Now, the reaction the president received in Asia was, of course, mixed. On the one hand, we have the president's meeting with the new Prime Minister of Japan. Let's take a look.
The first female Prime Minister in the history of Japan. Madam Prime Minister.
Looks like she really likes him, right? They're having a good time. So we have a bit more detail about Japan's $550 billion commitment to invest in the U.S. According to the memorandum overview released on the White House's website, about $330 billion of that will be in U.S. power infrastructure. So nuclear reactors, power substations, turbines, and so forth. And it's going to be in cooperation with U.S. companies. So what this looks like to me is that the U.S. is trying to use Japan's help to build up U.S. expertise and is also concerned about the electricity demands of AI going forward. So in a sense, they're trying to basically, with Japan's help, rebuild some of the U.S.'s infrastructure. So that seems like a really good idea. When it comes to South Korea, also very good reception. The South Korean president gave the president a gold crown, literally a gold crown, and promised to make $350 billion in investments in the U.S., largely in technology. However, South Korea does not have as much cash as Japan, so they're on a schedule where they're saying they're going to disperse $20 billion a year. It's going to take some time, but of course, better than nothing. Now, there's some commentary that maybe this is all fake and so forth, but Japan in particular, usually very good, reliable, and honest allies. So don't see why they wouldn't follow through on their commitment, at least through the Trump administration. Same for South Korea. Now, when it comes to China, I think the president got a little bit different reception. Let's take a look.
Good to meet you. Great pleasure to see you again.
Good to see you again.
很高兴在这里跟您。Me too.
And we're going to have a very successful meeting, I have no doubt.
我肯定我们今天会有非常成功的会议。
But he's a very tough negotiator. That's not good.
但是他是很强烈的谈判者哦，这不好。
We know each other well.
我们相互之间非常了解。
So it seems like the president is overjoyed to meet Uncle Xi, but Uncle Xi is like, yeah, whatever. And this kind of shows in what actually happened in the negotiations. At the end of the day, the president lowered tariffs on China by 10%, essentially reducing the fentanyl tariffs on China, and in exchange got a commitment to purchase more soybeans and to look more into the production of fentanyl precursors, and a one-year pause in the implementation of the new rare earth regime that they could potentially use to control the supply of rare earths to the world. So overall, it seems like both countries got to extend this truce. There's stuff about port fees and so forth, but it seems to me that with a 10% reduction in tariffs, it was, of course, the Chinese that had the stronger negotiating hand and walked away with probably a better deal. But hey, the markets liked it. We front-ran that over throughout the week. And if you look at soybean futures, the soybean farmers of America are rejoicing because now they have someone to buy their soybeans. So things seem to have worked out for, to some extent, everyone. And I think that probably concludes all this trade negotiations for some time. So let's move on to the next topic, which of course is the latest report from the World Gold Council. Now, this past year, gold has been one of the top performing assets. We did have a notable tumble the past few weeks, which we've been talking about. But I think it's interesting that the World Gold Council here has this report breaking down more concretely the supply and demand factors that have been driving gold prices up almost 40% this year. Now, obviously, though, just to be clear, the biggest driver is increased demand in investments, but let's go over the few of them listed here. Now, first off, what are the basic demand drivers of gold? The most obvious one, of course, is jewelry. Before we had all this, de-dollarization, debasement, all that stuff, gold for most people is something that they use in jewelry. Now, jewelry, of course, is going to be more price sensitive, so over the past year, as gold prices have surged, we see jewelry demand falling. So that's no surprise, right? Things are more expensive, you buy less of it. Basically, it seems like demand for jewelry has been crowded out by other demands. The biggest driver in demand over the past year has been in investments. And investment demand in gold comes in two forms. One is through ETFs. So if you buy the GLD ETF, for example, the ETF actually goes and buys physical gold. So it's not purely paper. The second source of demand is, of course, just more traditional coins and bullion. Now, if you look at ETF demand for gold, it's been absolutely surging. So gold ETFs are global. It's not just GLD. There's actually a few in the US, and there's also gold ETFs abroad as well. And that source has been a very big driver in the gold price going forward. But if you look at more just physical demand, coin and bullion, it's also held up pretty well as well. Now, a second often cited narrative for gold demand is central bank buying. Now, we've all seen many charts where people say that central bank holdings of gold have actually grown more than treasuries, but that's super misleading because, yes, the central banks are buying more gold, but the reason that their gold holdings look bigger in dollar terms has largely been because of price appreciation. So central banks are buying gold, yes, but that huge growth in their gold holdings largely through price appreciation. Now, looking at this chart from the World Gold Council, what's interesting is that gold demand by central banks is actually lower this year than the last year. Now, to be clear, it's still historically pretty elevated, but it is lower this year than compared to last year. They have a very interesting chart finding which central banks have the largest demand for gold. And surprising to me, it's actually the Polish central bank that has the most demand for gold this year. So pretty interesting wrinkle. You'd think it would be someone like China, but actually it's not. Moving over to the supply of gold, it looks like the supply from mines has been pretty elevated over the past few years. But of course, mining supply of gold is full of randomness. You have accidents and so forth. And of course, you do have some mines that continue to come online. What I find interesting about this report, though, is its report on the supply of recycled gold or scrap gold. So one of the things that I remember back in the last gold rush after the great financial crises is that when the gold price became elevated, you had all these businesses sprouting out across the country saying, we buy gold. And what was happening was that the general public was seeing that gold prices have become so elevated, they were rushing to sell their gold, like their jewelry or their family heirlooms or whatnot, to cash out. Of course, what's implicit in that, of course, is that they're thinking that the gold prices had gone too high and they want to capture some cash. So far, though, even as gold prices remain elevated, the supply of recycled gold hasn't really jumped. So the reports seem to view that as some potential that maybe the retail public thinks that the gold price is could still go higher. Because if you thought it wouldn't go any higher, it would go and you would be selling your own gold. So far, looking at the price chart, we do seem to be consolidating. And so let's see what happens. Usually it takes a bit more time after we've had such a big tumble. All right, the last thing I want to talk about is this interesting research from the Federal Reserve about the president's impact, the impact of the president's tariffs on U.S. manufacturing. So the big picture, of course, is that the president would like to revitalize U.S. manufacturing. There's some very good reasons for that. National security, of course, can't be relied upon other people for lots of our goods, but also it creates jobs, right? So there's been a lot of loss of blue-collar jobs in the U.S., and the president would like to help those people out. The way that he's doing this, one, it's multi-pronged, imposing tariffs to make imports more expensive, a lot of subsidies through the OBBA, and of course, the dollar has been weakening. So it's a complicated puzzle, and they're trying to solve it. So how are they doing so far? Well, first off, we should be clear. The likelihood of a company looking at all this policy change and immediately building a new factory is not high, because when you build a factory, it takes a lot of money, it takes many years. And as we all know, there's not a lot of policy certainty. Maybe we get a new president in a few years, maybe Zohar Mandame or AOC comes online, becomes the president, and then we take all these tariffs out. Then, your multi-billion-dollar factory that was built with the view that tariffs would make domestic production attractive just doesn't work anymore. But what tariffs could immediately impact, though, is existing capacity. That is to say that tariffs go up and immediately imports become more expensive relative to domestically produced stuff. And so there's a good argument that factories that are already in the US could become busier. And there are some stories in major publications about this, but the data that the Federal Reserve presents shows a slightly different picture. First off, that they find is that manufacturing capacity in the U.S. is a bit low. So they definitely have a lot of excess capacity, whereas if there was a surge in demand, these factories could definitely ramp up. Now, the question is that manufacturing is a very broad field, and the president's protections extend unevenly, right? Huge protections in aluminum, in steel, and so forth, but other fields not as protected. So what the researchers did is, according to industry code, they tried to figure out a measure of how protected this industry is, and then find whether or not there's a relationship between changes in industrial capacity and changes in how protected the industry is. The thinking was that over the past few months, as protection for one industry increases, maybe there will be increase in their factory utilization. So they'd have less capacity, right? Because they're utilizing it more. Now they run this regression, and what they find is, according to this chart, there is no relationship. So it doesn't seem like these tariffs have been helping existing factories become busier. Well, that's kind of a head scratcher, right? Immediately, a lot of imports become more expensive. Why haven't these domestic manufacturers become a little bit busier in super protected sectors of the market? So they take a step forward and they look at a survey that asks these companies, why is your factory utilization relatively low? And this is what they found. It's actually super interesting. Now, according to what they found, is that the more protected industries actually have more oftenly cite a lack of demand. So what that means is that, yes, the tariffs are probably helping in the sense that imports are becoming more expensive, but there's just not a lot of demand, and that speaks to broader economic weakness, which, anecdotally, many of us hear. The second interesting finding is that these protected industries also have trouble finding qualified people. Maybe there's not enough people who are trained in these specialized trades or something like that, but that seems to be another reason why they have trouble ramping up capacity. So it's both demand and a lack of human capital. So it's not clear that the tariffs aren't helping, but it could be just the broader economic weakness is outweighing it. And the researchers are also careful to point out that these shifts take time. Maybe the people who are importing abroad, they need some time to readjust their supply chains, find domestic sources, and maybe it just takes some time for people to gear up in production. So we've only been doing this new tariff regime, for some time, and only recently have become to have more stability in tariffs. So this is something that we can continue to watch. Again, according to common sense, you'd think that if imports become more expensive, domestically produced goods become more attractive on the margin. So it doesn't seem like that would hurt. All right, so that's all I prepared for today. Thanks so much for tuning in. I'll talk to you guys next week.